Hey, Matt. As you know, I'm Susie Wyshak with Keller Williams, and I'm excited to ask you a few questions that have been on my mind lately about loans and financing and all of that good stuff. Do you want to introduce yourself?
Sure, yeah. Nice to be here, Susie. So my name is Matt Sharp. I'm a loan officer with Loan Depot. Been there about 7 years, and excited to have a market discussion with you and answer some questions. Hopefully I'll be able to answer everything you throw at me today.
You have been so far, so I think you will.
All right.
And I think these might be questions that other people are pondering in this odd market we're in right now in September 2022.
Yeah.
So first off, do you operate all throughout California, you personally?
Yeah, I'm personally licensed in California and Oregon. I grew up in Oregon, so I'm still licensed there. Loan Depot is licensed in all the states, so sometimes I'll get a client in California that's looking to move out of state, and we can help those people too. Majority of where we focus though is immediate Bay Area.
I have to ask because I go to Oregon a lot and I help people move there. Where in Oregon are you from?
A little town called Ashland, Oregon, in Southern Oregon.
You are?
Yeah, first town you drive through on the I-5.
I've only been there like 5 times this year, so we'll have to take it offline.
Well, that's a side discussion.
Yes, I've actually been shopping for real estate there and helping someone there. So that's so fun that I never knew that.
Well, we're getting to know each other better and better.
Yes, here in public. Yes, whoever's watching this, if you haven't been to Ashland from the Bay Area, it's the same distance as driving to LA as it is to Ashland. It's the first big city on the other side of the border from California, where you can do tax-free shopping and get tips from me on the best grocery stores and award-winning coffee. It's a great town, definitely.
And you can still, Oregon, I think, is like the last state or second to last state where someone will pump your gas for you, which is disorienting when you haven't been there before.
It's not that they will, it's required.
That's right. They will slap your hand if you try and pump your own gas.
Yeah, and I think they're familiar with ignorant Californians or self-sufficient Californians, if we're putting it positively. So the thing I've really been curious about are the programs and techniques that sellers can use to make it easier for people to buy a house nowadays. We hear about buydowns, and there's also the option for buyers to pay for points. Can you talk about what a buy down is?
Sorry, can you just repeat that real quick? Susie, you cut out there for a second.
Okay. Can you please talk about what is a rate buy down?
Yeah, and kind of how does it fit in today's market? Yeah, so a rate buy down is like one of the challenges we're seeing in today's market is around affordability. So home prices continue to rise and interest rates have come up a lot, which makes buying the same house today a lot more expensive as buying that house a year or two ago. And so one of the ways that we're helping people sort of bridge that gap or make it more affordable to buy homes are with these what are called temporary rate buy downs, where you can really high level purchase a house that you want and still arrive at a monthly payment, at least in the initial couple of years, that fits within your budget. So just an example, using rough round numbers, if today's interest rate for an $800,000 home with a 5% down payment is 6% on a 30-year fixed, this temporary rate buy down program will offer you a 4% interest rate in your first year, a 5% interest rate in your second year that you have the mortgage, and then years 3 through 30, throughout the rest of the life of the loan, you're back at 6% today's market rate. And so with today's market, the buyers have a little bit more leverage than they have in the past, and we're seeing it's becoming increasingly common to take advantage of that leverage and ask the sellers for a credit. And so what you can do is you can actually ask a seller on a property you're interested in to pay for your rate buy down so that you get a lower interest rate and payment for the first 2 years. And so it's a great strategy to take advantage of the market conditions and help buyers buy the homes that they want and still have payments that are affordable for them in the near term.
And can a buyer do a buy down, or is that only something a seller can offer, or could someone come to you and say, I want to do a buy down myself?
Yeah, absolutely. I mean, a buyer can do it as well. The reason that I like structuring it more where the seller is paying for it is because we strongly believe that interest rates are going to be trending down over the next 12 to 24 months. We're anticipating rates by the end of 2023 or early 2024 getting down to the 4 to 4.5% range. And to put that in perspective, that's about 1.5% lower or so than where we are today. So that represents a pretty drastic shift in the market. And so because we can't guarantee it, right? Nothing's a guarantee, but because it's maybe an 80 or 90% chance that that'll happen, probably closer to 90. If interest rates did go down and you spent a bunch of money up front as a buyer to buy down your interest rate, and then you end up refinancing out of that loan, you will have then spent money to buy it for a lower interest rate temporarily that is not your long-term loan. So you actually end up potentially wasting some money there. So because of where the market's headed and where we know interest rates are likely to head, it's a better use of the credit it's a better use of this like loan structure to have the seller pay for it for the buyer, if that makes sense.
So I feel like 50% of people I talk to think rates are going to keep going up. Where do you get the information that they'll probably go down, which is exciting, but I'd love to know who's saying they're going down?
Yeah, great question. So there's a lot of in today's, today, there's lots of information available out there, and not all the information is good information, right? Like the media is excellent at spreading misinformation. They also, of course, there's accurate reporting out there too, where they are giving you the facts. But where I get my information is I follow some of kind of the top mortgage market and real estate market analysts in the country. Specifically, there's a platform out there called MBS Highway that's run by a guy named Barry Habib. Barry Habib was Real Estate Forecaster of the Year, deemed by Zillow in 2020. So he knows his stuff, and I listen to him every morning. And he has thoroughly broken down kind of all the economic factors and momentum that will be leading us into a lower interest rate environment, and kind of explained all those drivers and how they work, and being in the industry. And I'm consuming that information every day. The average consumer out there is not subjecting themselves to boring mortgage economic talk like this and information, but I love that stuff, and I'm diving deep into it every day. And so that's the source of my information, someone who is arguably one of the most knowledgeable and reliable real estate and interest rate forecasters in the country.
So if you were buying a house now, if thinking that rates will probably go down, would you do an ARM? What would you personally do, and how would you decide?
Yeah, so if I were buying a house today, I practice what I preach. So I would be looking at any program that gets me the lowest interest rate and payment in the near term, assuming that I would be refinancing that loan in the next 12 to 24 months. I would be looking at ways to try to minimize my transaction cost. So that would be asking the seller for credits towards my closing costs. Because if you're going to be refinancing again, that's another set of transaction costs. So if you then have two transaction costs, a purchase and a refinance, trying to minimize transaction costs across those two transactions would be a smart thing to do. So I would be asking the seller for credits. I'd be asking the seller potentially if they can give me a credit that I could use to buy down my interest rate to secure even greater savings. ARMs certainly would be a great option. I think that would be those would be the strategies that I would employ. I mean, if you're more conservative, that may make you feel uncomfortable, and a traditional 30-year fix with a higher rate and payment might be better suited for you. But if if we are right and interest rates do go down, you may end up leaving some money on the table going with that more conservative strategy.
I have a client who feels that the closing costs are her barrier to having enough to put the down payment and the closing costs. You just mentioned I think a negative aspect of having the seller pay for closing costs. What would you say to a client who wanted a creative way to drum up more money to be able?
Yeah, that's a great question. So, buying a house is not inexpensive, but there are fortunately, there's lots of different programs out there and ways to help supplement the costs that come along with buying a home. So for someone like your client, there are loan programs out there, several different options through like state institutions like Cal HFA has a program that allows you to have no money down and cover all of your closing costs to buy a house. And you can buy a house up to, $800,000 or $900,000 single family home utilizing their program. And then there's GSFA is another program that has down payment and closing cost assistance. And there's other programs out there as well. And even just conventionally, if you're not utilizing one of those special first-time home buyer programs, and just asking for a credit from the seller and the way you structure your offer is a really effective way to reduce those closing costs, because those closing costs sometimes can be $15,000 or $20,000, which on top of your down payment is, it's an extra $15,000 or $20,000, right? Not everyone has that. So.
Yeah, it's so important to factor in. And I always try to get an estimate of that early on in the game to know what we're dealing with.
Yeah, but it is great. I mean, there are lots of options out there for people, and there's even Cal HFA just rolled out their Equity Builder program, which has its limitations, but for the right candidate that qualifies, it can mean it's a forgivable loan up to 10% of your purchase price. So if you're buying a $600,000 property, they'll give you $60,000, and that loan is forgivable over 5 years. So that's a pretty awesome program, and we don't know how long that money will last. So if anyone's shopping in, the $500,000, $600,000, $700,000 price range, that's a great program to take a look at.